Good morning, everyone. Welcome to Nova 401k Associates webinar on partial terminations in a pandemic. Today's webinar is eligible for CPA, IRPA, NIPA, and ASPA CE credit. Right after the webinar ends, you will see the survey pop up if you are needing one of these credits. We have also added the slides as a handout. Just click the handout drop-down on your GoToWebinar panel, and you can download and save the file to your local folder. Today's presentation will be presented by Craig Hoffman. Craig is an attorney/senior consultant with Nova. For over 35 years, Craig's practice has focused exclusively on federal tax and ERISA matters relating to design, implementation, and operation of tax-qualified retirement plans. If you have any questions, please type them in the questions box, and if time permits, we will answer them at the end of the presentation. Craig, please take it away.
Thank you, Andrea. Hello, everybody. Welcome to our pandemic webinar. I mean, happily, the pandemic is ebbing and things are getting back to some degree of normalcy. I'm sure we all feel better for it. But nevertheless, we're in a process of dealing with the 2020 plan year and some of the implications, unfortunately, of the pandemic will affect how our plans are in compliance. And one of the areas of hot topic, if you will, is partial terminations. A partial termination is an event that is called for under the Internal Revenue Code, and as we'll see, for better or worse, these rules are really coming into play over the last year. And as a result, Congress has provided some last-minute relief in December of last year. So what we're going to do is go over the mechanics of how these rules work, and then we'll talk about the relief and then some concerns we have. And this is timely because we did just get some FAQs from the IRS with regard to applying the relief that was included in the Consolidated Appropriations Act. So, let's get going. Okay, so a partial termination is part of the vesting rules. The vesting rules are found in Internal Revenue Code Section 411, and we all are familiar that you can apply a vesting schedule based on years of service to certain accounts. Generally, it used to be all accounts, but as 401k plans have become obviously very popular. I hate to say it, I was practicing before they were popular, but we now know certain accounts like elective deferral contributions, QNEX, QMAX, safe harbor contributions, contributions to simple, after tax, they're always 100% vested. So what we're really talking about is the potential impact a partial termination may have on accounts that are subject to a vesting schedule. The provisions in Code Section 411 generally have those vesting rules, but there is an override, as I've cited here in subsection D3, that requires upon the termination or partial termination of a plan or the complete discontinuance of contributions to a profit-sharing plan that all affected participants' accounts must vest. So that's how it is in the code, and that came in as part of ERISA back in the 70s. And we have a regulation that's similarly of the 70s, and that's about all we have. The regulation is not filled with a lot of help in objective standards. Rather, it's very facts and circumstances oriented, and the IRS, the commissioner, the IRS is given great discretion. Whether or not a partial termination has occurred shall be determined with regard to all the facts and circumstances. Such facts and circumstances include, but there may be more, the exclusion by reason of a plan amendment or severance by the employer of a group of employees, or a plan amendment that adversely affects the rights of participants to ultimately vest in their benefits. And that, frankly, is where the rule has now focused, and that is how many people have been severed from employment. There is a special rule for defined benefit plans in circumstances where a potential for reversion of plan assets is created or increased as a result of ceasing or reducing the rate of future benefit accruals. This doesn't happen all that often. It can happen if the plan is overfunded at the time accruals cease, but it is a special rule and only applies to DB pension plans, not money purchase pension plans. So we have this rule, okay? So what are the consequences of having to follow this rule? Well, there are both potential consequences from the IRS and DOL. Let's talk about DOL. Now, the IRS will require you to have this language in your plan document that describes the fact on a partial termination, all affected participants must vest. ERISA doesn't have that specific provision. However, there is a requirement under ERISA that plan fiduciaries operate the plan in accordance with its terms unless contrary to ERISA. So the fiduciaries have an obligation to apply the terms of the plan. And I think there's also a potential obligation. Fiduciaries are obligated to provide the promised benefits the plan calls for. And if the fiduciaries are not properly giving full vesting upon a partial termination, then that would likewise be a fiduciary breach, apart from not following the terms of the plan document. So there are consequences from a DOL side. I think we're all more familiar with the potential consequences from the IRS side, because failure to properly apply the partial termination rules is a disqualifying defect. As I said, your plan is going to have the language in it that calls for full vesting on a partial termination. And so what you've created is an operational defect. And so it is up to the plan administrator to follow the terms of the plan, and also to determine which participants are affected participants by the partial termination, and therefore the ones that should be fully vested. Now, what happens if the IRS down the road after the fact determines there was a partial termination? Or let's say you're dealing with a client today and you realize, oh, they should have had a partial termination last year. It may be difficult to fix. If participants have been paid out and were not fully vested, people who were affected by a partial termination, it's likely their forfeitures were either reallocated to other participants. They may have been used to reduce employer expenses or contributions. Either way, they're going to have to be made up. And EPCRS does have provisions for vesting failure. Typically, the employer is either going to have to come up with the money to replace those monies that were incorrectly forfeited. It is possible you could use that reallocation approach if the money's still sitting in other people's accounts that shouldn't have gotten those forfeitures. My experience is most folks don't like using that reallocation approach. Obviously, it depends on how much money is involved. So getting it right at the start avoids a lot of problems. So it is certainly something we need to be sensitive to in these tumultuous times of the pandemic. Now, I quoted you the regulation, and it basically says as determined by the IRS based on facts and circumstances. So the IRS is given a great deal of discretion in how they apply these rules, if you will. And there are two ways they do so. One is through audits. Obviously, they have, we'll talk a little bit later, but partial terminations are an area of interest to the IRS and the audit side. And you can also get a determination letter believe it or not, on whether you have had a partial termination, and you file the same Form 5300 that would be normally filed for an individually designed plan, termination letter on their plan, but there is a section on the form where you give oodles of information about what happened, and the IRS will then opine. I think in most cases, if you are, well, we'll get back to what your options are down the road. But that is one way the IRS exercises discretion. And like I said, audits are of interest in this area to the IRS. In 2014, specifically with this in mind, the IRS added a question to the 5500 that requests the number of active participants at the beginning of the plan year and the number of active participants at the end of the plan year. And as we will see, that is the main test by which a partial termination is determined these days. And the IRS, they know how to use return information to target taxpayers, and they have indicated they are doing so in this area. In fact, as I was alluding to, the IRS every year puts out where their enforcement initiatives will be for the coming year. And the 2021 page it's on their website. I gave you a link to it in the PowerPoint. They have announced a compliance contact letter initiative. So this is not a full-blown audit. And we've seen this in the past with certain issues on 401k plans and the like. The IRS will send out a letter to employers, plan sponsors targeted principally because of their active participant data. And the IRS will, in a nice fashion, say, hey, by the way, is it possible you had a partial termination? We're looking at this active participant data. Please explain. Now, the worst thing you can do is just ignore that letter because you're sure to be targeted for a full-blown audit at that point in time. But it does require, employers to take a look at what happened. And unfortunately, sometimes after the fact, it's discovered, yes, we did have a partial termination. So it's important to be on top of it as it happens. And obviously, 2020 is going to be an interesting year for this data, not only because of the record layoffs we have seen, but also because of this relief that came at the midnight hour at the end of last year. The 2020, at least calendar year forms are only now, we're not in the height of the filing season. I know some good doobies have maybe already filed a few 5500s, but the 2020 forms are not in the IRS database yet. However, as we'll see, the fact is, though, this could affect folks with fiscal year plans. If you've got a June 30 year end that ended June 30th, 2020, you might well have active participant data that shows you had a partial termination based upon the number of people on July 1 of 19 versus June 30th of 2020. So this is going to be coming up, and my point is, again, don't ignore this issue. It's more important than ever. And so the mechanics. The most important factor the courts and the IRS have focused on is whether a significant group of participants has been excluded from the plan as a result of an employer-initiated severance from employment. So again, it's a significant group who have been excluded from the plan as a result of an employer-initiated severance from employment. And it could also be an employer-initiated action if the plan eligibility was changed to exclude a significant group of participants, that would be treated likewise as a partial termination with regard to those folks. But we're going to focus again on the severance from employment side of this determination. And so the test looks at the percentage reduction in plan numbers rather than the rote number of participants who have been severed from employment. And what has developed over the last 30, 40 years is sort of a bright line test, you might say. It's not so bright line when you look at it more closely, but generally speaking, the IRS presumes a partial termination has occurred if the turnover rate is at least 20%. Now, the landmark case in this area is Motts versus Household International, and that is where the IRS came up with their 20% figure. But Motts actually provided, I think, a little more detail of what's going on, and Motts provided sort of a schedule of how to look at whether a partial termination has occurred based on the percentage turnover. And the Motts case said essentially if the turnover rate is less than 10%, it's an irrebuttable presumption, no partial termination. If it's between 10 and 20, it's still facts and circumstances, but the presumption is there was no partial termination. And I think the IRS doesn't really fight that going lower than 20. When you get between 20 and 40%, the Motts court says that it is presumed that a partial termination has taken place, but it can be rebutted. And we'll see there are circumstances that allow a higher turnover rate than 20% to not result in a partial termination. We'll talk about that in a second. If you're more than 40%, you've had a partial termination, it's irrebuttable, you're done. So the IRS focuses on the 20%, but it gives us some idea of what may be in between. So what is the turnover rate? And it's simple math. You divide the number of terminated participants by the active participants at the beginning of the year plus any new participants added during the year. Now, I say year, it's actually the so-called applicable period, which is typically looked at as a single plan year. However, there can be circumstances where there may be a series of layoffs over a period of more than 1 year that are actually considered by the IRS to be one event, and they will then treat it as such. And if the turnover rate from the beginning of the event to the end of the event is more than 20%, they're going to argue it's a partial termination. And so it depends on the facts and circumstances, but generally, and I think for our circumstances, given the pandemic and everything else, we can feel pretty comfortable the applicable period is the plan year. So, in determining the turnover rate of 20%, the question that has been litigated in the past is whether you take into account everybody or only those participants who are not fully vested and therefore potentially affected by the partial termination. And the courts, Motts and others, have affirmed that no, it's everybody, even those 100% vested people. So if we're dealing with a 401k plan and you've got an employee who only made elected deferrals and has been severed from employment, that person goes into the mix as a termination. But it would also mean that those same people one would think would count when we determine who was an active participant. I'll come back to that. That we actually did get a little guidance on that in the FAQs. So, okay, so we know 20%, and the next question then is, well, what is an employer-initiated severance from employment? And that's been litigated back and forth, and it's a facts and circumstances test. But if you want to stay, if you will, within the IRS, I guess I'd call it a safe harbor, the ruling in Rev Rule 0743, which remains the name revenue ruling in this area. An employer-initiated severance is any severance other than death, disability, or retirement on or after normal retirement age. That's pretty much everybody. And the 0743 Rev Rule goes on to say that severance is employer-initiated even if it was caused by an event outside the employer's control, such as depressed economic conditions. In today's day and time, we can put in such as a pandemic. So there's no pass from the partial termination rules just because we have a pandemic. Now, again, we'll talk about some special relief that was generated by congressional concern about the pandemic, but nevertheless, people who have been laid off because of the pandemic have had an employer initiated severance from employment. Now, the Rev Rule does acknowledge that the employer may be able to verify that an employee's severance was not employer initiated, i.e. it was voluntary. But it says you need to support that through items such as personnel files, employee statements, other corporate records. Now, a lot of companies do exit interviews, and you have that information, and that's something you need to maintain. And, you know, if you're doing the administration, you need to, if you're the plan sponsor, you need to maintain those records. If you're doing the plan administration, you got to make sure somebody is keeping track of those records in case you do get audited. Now, moving from an employer to an unrelated employer is not a employer-initiated severance if that new employer assumes sponsorship for that same plan that's been spun off to it or the like, and that makes sense. You're not being excluded from the plan. However, you need to be careful, too, that employees who appear to terminate on a voluntary basis may ultimately be found to have had an employer-initiated severance by virtue of this theory of constructive discharge. And the idea is the employer has made the workplace so intolerable that the employee had no other course than to quit. Essentially, the employer fired him by making life miserable. And you know, the Rev Rule talks about what was the employer's intent, what were working conditions like, the reasonably foreseeable impact of the employer's actions on the employees. Where I have seen this come up is where an employer has two locations, and you know, you may have a place in business in Houston and another in Dallas, and you now close the Houston shop and tell the employee you still have a job, but you got to now commute to Dallas. And that's a classic example where the IRS would say, no, that's unreasonable, and that is an employer-initiated severance from employment, at least for purposes of the partial termination rules. Another question that has come up during the pandemic is the idea of a, quote, furloughed employee. And you know, that's an interesting term, furloughed, but it is not a legal term of art. There's nothing in the regulations dealing with qualified retirement plans that, to my knowledge, uses the term furloughed. Now, somebody's probably going to find it some obscure place, but really what we're talking about is the same issue that we've dealt with in 401k plans for years in circumstances about monies that are restricted, that cannot be paid out while the participant is still working. Has that participant had a severance from employment in the context of work such that they now can get their 401k distribution. And so I believe the IRS would apply that same concept in the context of partial terminations and, quote, furloughed employee. And I think it comes down to, is there, a bona fide severance in good faith? The example that I throw out there is a defined benefit or an elective deferral. There actually have been some case law where an employee severed employment, started taking payments from his or her defined benefit plan as a retiree, and then went back to work. That would be a violation of the in-service distribution rules if they weren't of normal retirement age, and that is not a bona fide severance from employment. You can say the same thing of an employee who quit to get at their elective deferral account. And so I think you look at the bona fides of what the circumstances are. Is this person who's furloughed still being treated as an employee for other programs, or have they been cut off from health coverage? Did they get their COBRA notice? I think that's a pretty strong example. They've employment. Is there a reasonable expectation the person will come back to work, or have you taken away his laptop, taken away that employee's entry card into the building? I mean, it's a facts and circumstances test is all I can tell you, and each case has to stand on its own. So let's take a look at a little case study here for our viewing pleasure. Did these people have an employer-initiated severance from employment? The employee dies? No. Employee retires at age 75? No. Employee fired for stealing? If you got an answer, let me know. I'll give you my answer. I hope that is not an employer-initiated severance. I would hope the IRS would treat that as a voluntary severance caused by the voluntary actions of the employee who was stealing. But I would make darn sure I document that in the way the Rev Rule suggests, and to avoid having to treat it as an employer-initiated severance. Employee quits because he doesn't want to report to a new work location 60 miles away. Well, we get into constructive discharge here, and it's 60 miles. What if it's 200? Probably too much then. If it's 20 miles, probably that's okay. So, it depends. What if the employee quits to take a new job? There, it's not employer initiated, but again, we need to have records. If we don't have records, the IRS and audit is going to presume it was an employer initiated severance from employment. What if the employer reduces the workforce? They hold out a early retirement bonus to people who retire right now, and 15 employees take the bonus before normal retirement age. I don't know. The IRS would not, you're getting paid before normal retirement age, so it's outside the Rev Rule. There is some case law that would suggest this is a voluntary employee initiated, but I think you might be bucking the IRS on audit on this issue if you took that approach. Employer sells the plan, spins off the buyer, keeps the plan going, employee goes to work there. No, that's not a severance. Employer initiated. The employer lays off employees because of the pandemic. Yes, that is employer initiated. Employer furloughs employees who were told when conditions improve, they could be rehired. I'd be inclined to view that as an employer-initiated severance. Could is not, I don't think it's a reasonable expectation you're coming back. But again, as I mentioned, facts and circumstances control. How about this the focus of this is the potential of this case study is the potential impact of these rules on smaller employers. We got Joe. He's got a barber shop, the calendar year 401k plan. Everybody's eligible. He's a nice employer. On January 1 of 19, he had 9 people working for him, hired a new person in July. But during the year, 2 of the employees got fired, one because he was habitually late and the other was stealing. So this poses a couple of questions. The turnover rate is 20%, but it's only 2 people. Is there any break for smaller employers? I don't know. I mean, many of you know, I was general counsel at ASPA, the American Retirement Association, and involved in government affairs. And back before that, and in 2007, I was a volunteer in government affairs, and we definitely raised the issue with the IRS, and that rev rule needs to be applied in a more lenient fashion when dealing with the smaller employer. In practice, I'm not sure what the IRS is actually doing. Obviously, in this particular case study, I think Joe can make the additional argument, assuming Joe has paperwork, that these were not employer initiated, or at least could make that argument. Not sure how it might turn out. What else can rebut a partial termination? That is a showing that the turnover rate for this particular employer, even though higher than 20%, is normal for their business. And if it's normal routine turnover, then a partial termination has taken place. Now, I'm not sure there are many McDonald's that have profit-sharing contributions being made for the guys and girls making your hamburgers, but think of what the turnover may be in such a business. And so what the IRS manual tells you to do is to look at a base period, which is at least 2 years preceding the current year, and compare the current turnover rate to the base period rate, and look to see, did the rehires that came in, did they perform the same jobs, which is indicating routine turnover. Did the new employees go into the same job class or title? Again, routine turnover. New employees receive comparable compensation, again, indicative of routine turnover. So there is a way to rebut it on account of so-called routine turnover. And that certainly should be considered as we apply these rules in the pandemic, though I think nobody will have what might be termed routine turnover over the course of the last 18 months. The next question is, who is an affected participant who therefore must fully vest as a result of the partial termination? And one would think it's the participants who had an employer-initiated severance, but no. Rev Rule 0743 says any participating employee who had a severance during the period must fully vest, even if arguably it was a voluntary severance. Now that, again, seems contrary to 411D3, but I'll leave it up to you if you want to fight City Hall and take them to court over it. The IRS audit guidelines, which I've given you a cite to, confirm that is the audit position of the IRS at this time. One other point, if you remember way back at the beginning, 411D3 does require full vesting upon the discontinuance of substantial contributions to a profit-sharing plan. And this can happen as a result of a formal action to freeze the plan, or perhaps more problematically, can happen over time because the employer just stopped making contributions. And if that is the case, then the full vesting event goes back to when the last contribution was made, which again can be problematic if we've been paying people out over that period and forfeiting their non-vested portion of the account. So this is, an important concern. The IRS audit guidelines presume a complete discontinuance of significant contributions, substantial, if there is no substantial contribution for 3 out of the last 5 years. Again, that's a presumption. It can be rebutted. A suspension could arguably be rebutted by, the fact is the IRS looks at, not to rebut, but to look at, excuse me, I got a little lost there for a second, that this is a discontinuance is whether there is evidence the employer was basically stopping contributions in hopes people would leave and be able to take advantage of the forfeitures. Obviously, the lack of recurring or substantial contributions and the probability that the suspension will continue. What has come up over the years is whether employee elective deferrals alone are sufficient to constitute substantial contributions. And again, showing my age, at the ASPA annual in 2003, we did an IRS Q&A session. I think it was Dick Wickersham and Jimmy Holland, if I'm not mistaken. I could be wrong, but I was on the podium with Mr. Wickersham and Mr. Holland, and we raised this question with them, whether elective deferrals were enough, and they said, yeah, that sounds right. With that said, I stumbled recently across an IRS webpage that shows they've been targeting for compliance letters. Remember I told you about that compliance letter where they just send out this letter and say, hey, we think you might have a problem. Well, they're sending one out for profit sharing plans where there have been no contributions for the preceding 5 years. Well, that's fine, but then they say, excluding 401k plan elective deferral contributions, which I read that to mean rather that if a plan only had elective deferrals, then that didn't count, and they're going to get this compliance letter. I think they're wrong. I think elective deferrals are sufficient, and I'll come back. There was some guidance in the FAQs that recently came out dealing with what is an active participant, but I think it's analogous to this, and I think at the end of the day, I feel comfortable in saying elective deferrals to a 401k plan, even if they're the only contributions, they're sufficient to be substantial contributions, assuming they're being made. So, we now know sorry about that. I get excited sometimes. I know I have a loud voice. I just have so much fun doing these things. In any case, so what do you do if you think you've had a partial termination? Well, one, you can request, if you're not sure, you can send in the form 5300. There's a detailed worksheet you have to fill out for this particular ruling. And the normal $2,700, now $2,700 user fee applies when you submit Form 5300. So that's one approach. Alternatively, you could consider fully vesting every affected employee just to eliminate the question of whether a partial termination took place. And actually, I was on a panel recently talking about partial terminations. Again, I have no life. And one of my co-panelists said she recommends always doing a plan amendment, even if you're sure it's a partial termination, so as to memorialize the event. So it's clear, if you are ever audited, how the plan chose to treat who was affected and who was fully vested. And I thought that was a great idea. So, I'm the Henny Youngman of good ideas. I stole that and stuck it in my slides as well. I recommend that. I think that's a good recommendation. Now, there's no specific reporting of whether a partial termination has taken place on the 5,500. There's not a box to check, yes, we had a partial termination or not. But there is the reporting of active participant counts at the beginning and the end. So the IRS has the data to find these plans, and they are doing it as we speak. So that's where we stood, and the pandemic hit. And obviously, we had unprecedented layoffs. And the original CARES Act, the first legislation to address the pandemic, did not have any relief in it relating to partial terminations. It obviously had some retirement provisions, COVID distribution, things like that. But I know organizations such as ARA that they had been lobbying for partial termination relief in the original CARES Act and continue to do so over the course of 2020. That ultimately resulted in its inclusion in the December budget bill that President Trump signed last year. Now that funded the government through the September of this year, the 2021 fiscal budget, but it had a lot of stuff otherwise dealing with the pandemic, and one of them was partial terminations. As we've already said, a lot of layoffs. There were hope people would come back by the end of 2020, but that didn't work. And so under the normal rules, we did have a slew of partial terminations. And actually, this relief in some respects is maybe problematic because people have applied the normal rules, and now at the last minute, Congress changes the rules, essentially. But it is on a limited basis. What did they do? They basically extended the period for rehiring employees, the applicable period, if you will, from the end of, let's take calendar year, because the legislation's aimed at calendar year plans, but applies broadly to every plan. But the idea is rather than having to measure the applicable period as of December 31, 2020, we're given until March 31 of this year. So obviously, this only helps businesses who are able to recover by March 31. I think there would have perhaps been a longer period for this to rehire people, but the original lobbying was based on the assumption that this relief would have been adopted by Congress a lot earlier in the year. For better or worse, it is what it is. March 31 is now the period to look at. And the actual wording is like I said, it was aimed at calendar year plans, but its reach is now far broader. The wording says a plan shall not be treated as having had a partial termination during any plan year, which includes the period beginning March 13th of 2020, when ostensibly the pandemic began, and ending on March 31, 2021. So the relief is available for that period. We'll come back to the 80% test in just a second. So that covers a broad brush of plans. And there was some question, how broadly should we read that? And as I said, the end of last month, I think, the IRS added 5 new FAQs to their website. You can find it at the link I put in the PowerPoint slides. And FAQ 3 confirms that if any part of a plan year is in that period, then the relief applies, and you apply the rote test that we're going to apply shortly. So, for example, if a calendar year plan year, the relief applied to both January 1 and December 31, the 2020 year, but it will also apply to the 2021 year because both of those years have a day in it, at least one day that's in the stated period. And the same is true for non-calendar year plans. So there's a bevy of non-calendar year plans But then the rule gets kind of funny because, well, I don't know if funny is the right word, but you have all these plan years potentially affected, but the test still depends on who you had on the books on March 13th and who was there on March 31 of this year. And that's where the second significant change comes in. What the law says is normally, let me get to the normal, as we talked about, in order to avoid an employer-initiated severance, you got to rehire the same employees. However, and many employers could not rehire those same employees. They've moved on to greener pastures, or they've had to find whoever they could. And so what the new law says is, rather than having to rehire the same people, you will be deemed not to have had a partial termination if the number of active participants on March 31 of this year is at least 80% of the number of active participants on March 13th of 2020. So this overrides the normal rules, and these are two dates. We're going to have to get the data on how many people were there on March 31 and March 13th in order to apply this test. So there may be some challenges in that aspect of the test, but again, you use those two dates irrespective of what year you're dealing with. So let's look at an example. Tom's Restaurant sponsors a calendar year 401k plan, immediate eligibility. March 13th, 50 employees all in the plan. May 1st, everybody's laid off by Tom, but he was able to get going again, and on February 1, he had a total of 45 employees, including himself. Did he have a partial termination under the normal rules? Heck yeah. It was 1 out of 50 still working on December 31 of the applicable period, the 2020 plan year, 98% turnover rate. Yes. But what about the relief provisions? Well, now on March 31, we've got 45 people in the plan. We don't know how many of them were rehires, but it doesn't matter. We've got 90% of the count we had on March 13th. No partial termination. But what if instead of immediate eligibility, Tom's plan required 3 months of service to be eligible, and only 10 of the people rehired had 3 months, had that requisite service, and therefore the relief will not help Tom, because the only 10 of 50 are back, and that's not 80%. What if Tom's plan had immediate eligibility only for elective deferrals, and you had to have a year of service to get matching contributions? Here is where we've gotten the recent guidance. And FAQ2 of what just came out, you can read it as well as I can. A reasonable, good faith interpretation of the term active participant covered by the plan, applied in a consistent manner, should be used for determining the number of active participants. And I think it's perfectly reasonable and good faith to try to treat elective deferral only people as active participants. Unfortunately, it's too late to go back and add anybody if that might have been desirous to avoid the partial termination. So, finishing up, the law wasn't signed until December 27th, 2020. What does that mean for people who have already determined they had a partial termination? You got the calendar year plans. There was something in the wind when they knew it. But think about a June 30th, 2020 year end. That employer could well have, had ceased operations in March, and by June nobody was back. But by March of this year, March 31, they're back up and running. Well, that June 30 year ended 6 months after CAA was enacted, and people have been paid out And now this relief is saying, no, wait a second, you didn't have a partial termination. What does that mean? Is the plan sponsor required to somehow unwind the full vesting? Can you go ahead and treat them as fully vested, even though the normal rules, under normal rules? And if you do that, do you need a plan amendment to implement that override of the relief? All good questions, I would say, and I don't have those answers. I know the IRS has, they've got those FAQs. I believe these questions have also been raised. I think they're a little perhaps more difficult to answer in an FAQ, but I think if you've already had this happen, the June 30, I think the prudent thing to do at this point would be to adopt a simple amendment in an abundance of caution indicating the plan's operations in accordance with its terms as it existed at that time. In closing, this relief may be helpful in some circumstances, maybe a lot. I mean, it just depends on where the employer stood on March 13th of last year compared to March 31 of this year. It's certainly something you need to take a look at. Keep in mind that the PBGC reportable events, when there's a drop in active participants, many, not all, there are a fair number of exceptions, but a number of DB plans are required to report when there's been a drop in the active participant count, and nothing's changed in regard to those rules in this relief. Other than that, Andrea, do we have any questions with the few minutes we have remaining?
Yes, Craig, we did receive a handful of questions, so I'll go ahead and read that first one for you.
And let me just add, if I don't get a chance to answer all the questions, I'll reach out to the individuals who sent them in through email.
Okay. So our first one, if we haven't had any profit sharing distributions, every participant is fully vested. There is a vesting schedule for the profit sharing, so how would this apply to a safe harbor plan?
If all accounts are already fully vested, there's no application. Its only application is to cause accounts that are not fully vested at the time of the partial termination to fully vest. So if you've got a safe harbor plan where all accounts, all contributions are fully vested, then you don't have to worry about the partial termination rules. Next.
Thank you. Our next question. How will the new part-time, long-time employees who work over 500 hours over 3 years is eligible to participate for deferrals? So using the McDonald's example, they have high turnover. Will this feature cause plans to have partial plan terminations more often?
It's going to be a question of the facts and circumstances. I don't know of any lesser status as an active participant that will be accorded a long-term part-time employee who enters by virtue of that. Now, I think the questioner points out, I think perhaps correctly, that your turnover rate may go up as a result of including them. It's a question of facts and circumstances as to, another aspect of it will be being able to verify that it was a voluntary turnover but through documents rather than an employer initiated. But bottom line, I think there could be some adverse effects of long-term part-time employees because at the moment, I don't see any rationale for treating them differently when it comes to applying the partial termination rules. Next.
Is there a time limit on how long an employee can be furloughed due to COVID?
Again, furlough is not a legal term when it comes to partial terminations. There may well be significant HR and employment law questions associated with that, which are beyond my area of expertise. I go back to, for partial termination, It's not a question of furlough. It's a question of a reasonable expectation that this person will come back and is still being treated as an active employee. Next.
Does the CAA only apply to plans that have vesting schedules?
Yes. I mean, again, that kind of goes back to the first question. If all accounts are fully vested, then the partial termination rules, as well as the relief provided by CAA, does not apply.
Perfect. Thanks, Craig. Well, it looks like that's all the questions we've
got them all right.
Have any closing comments?
I hope you enjoyed it. Andrea is going to usher us out. Keep friends of follow Nova 401k on LinkedIn, and we'll be sure to announce some future webinars as they are scheduled. So thanks for coming today.
Thanks, Craig, and thanks everyone to joining us today for our webinar. Please note there will be a survey that will pop up right after the webinar ends for you to complete if you need CPA, IRPA, NIPA, or ASPA CE credit. So please be on the lookout for that, and the certificates will be sent out in 1 week, and a recording of this webinar will be made available on our Nova YouTube channel, so please go like and subscribe. And if you have any questions, please email webinars@nova401k.com. Everyone have a wonderful Wednesday.
Bye, everybody.